is the most important video I will ever make about finances. If you don't take away anything else from this video, I urge you to stay with me because I'm about to give you the first, last, and only piece of investing advice that many of you will ever need to hear. Hi, this is Stephen King, former hedge fund manager and Wall Street trader, and welcome to the channel that gives you the tools, strategies, and mindset needed to build wealth. Whether you're just starting in your investment journey or you've been trading for years, there's something in this video that everyone needs to hear. I'm going to start by revealing one of the biggest mistakes I see almost everyone make when it comes to investing and how you can avoid it. This is critical information, especially for those of you who rely on financial advisors or company retirement plans. But here's the exciting part. If you're looking for more advanced hands-on trading strategies, the kind that professional traders and market makers use, stick around. Because later in this video, I'm going to dive into the exact methods I use in my own personal investing. Methods that you won't find except in a few upper-level graduate or PhD finance courses in just a handful of the most elite colleges. So, whether you're here for the most crucial piece of investing advice that you'll ever hear, or you're ready to learn more advanced strategies, you're in the right place. But first, let me tell you about the biggest mistake I see almost everyone making today. It's an easy trap to fall into, especially with the way company retirement plans are set up. The financial industry uses all kind of jargon to confuse and intimidate regular people just trying to invest. As we get older and accumulate wealth, it's tempting to let our companies pick our retirement plans, especially if they offer matching contributions. And while I'm never in favor of leaving free money on the table, once we're in those plans, financial advisors don't always make it easy to leave. By the way, stay tuned for an upcoming video where I'll teach you how to break up with your financial advisor. For many of us, as life gets busier, calling an expert seems like the safe, responsible thing to do. But today, you'll see why I put expert in quotation marks and what you should be doing instead. Back in 2008, Warren Buffett, one of the most successful investors in history, made a bold bet. He wagered $1 million that the S&P 500, which is basically just a stock called an index fund that acts like a basket and holds the 500 largest companies in the US, would beat a group of the most skilled, highly paid money managers over a period of 10 years. Now here's what Buffett knew. Stock picking is incredibly hard. He understood that in the long run, about 80 or 90% of active managers can't consistently beat the market, specifically the S&P 500. Why? Because the market itself is unpredictable, a concept known as random walk theory, which is a little outside the scope of this video, but we'll definitely be diving into that in a future video. But there's another reason that most managers fail: fees. So, how did the bet play out? 10 years later, Buffett won. The S&P 500 returned 125%, about 8.5% a year, which is close to its historical average. And how did the professional money managers do? Well, it wasn't even close. They only returned 36% during that same period of time. That's right, only 36% after fees. Now you might be wondering, why did the money managers underperform so drastically? Yes, picking stocks is hard, almost impossible, especially without some type of insider knowledge or information in today's market. But the real kicker are those two words that I mentioned earlier: after fees. Most people don't realize just how much these fees eat away at your returns, especially when compounded over the years. Every time you make money, you earn interest not just on the original investment, but also on the interest from previous years. This is what makes compound interest so powerful and why Einstein called it the eighth wonder of the world. For simplicity, let's take the example of a 35-year-old investing $100,000 for retirement. At an 8% interest rate, they would end up with about $1 million at age 65. So over those 30 years, the money didn't just double or triple. They got a 1,000% return. But to really understand the power of compounding, consider this. How long would it take to earn the next million? If the money didn't compound, it would take another 30 years. But if that same person had invested at age 26, just over 9 years earlier, they'd have just over $2 million at age 65. And if they waited until age 70 to withdraw, just 5 years later, they'd have nearly $3 million. This is the power of compound interest. Let me share a mind-blowing fact. Did you know that if you fold a piece of paper in half 42 times, it would reach the moon? 43 times, and it would reach the moon and back. Now, I know this is hard to visualize, so I'll put a link to the thought experiment in the description below. But that's the power of exponential growth. And it's the same with compound interest. Small increments can lead to astronomical results over time. It's also why the rich get richer and why the hardest money you'll ever make is the first money you'll make. Which is exactly why I created this channel. I want to help lower the barrier of entry and get you there faster, regardless of your age, responsibilities, or income. I've worked with people ranging from teens to college students and family offices with hundreds of millions of dollars. So if you'd like me to continue making videos and show you exactly what I taught them, I'd love for you to subscribe. And if you know somebody who could benefit from this, please share it with them, as it's word of mouth referrals that helps this message grow. So now that we've seen how compounding affects your account and how much money you'd make with an 8% return, let's look at what would happen when fees come into play, like those often associated with typical retirement accounts. If you invested at 35, making that same 8% return, but paid a 2% annual fee, instead of earning $1 million, you would have ended up with only $574,000, meaning you'd lose 43% of your total life savings to fees. Now, the 26-year-old investor fares even worse. Instead of making $2 million, they would have ended up with just $970,000, meaning they would have paid over $1 million, more than half of their retirement savings, to their money manager. See, over a 30-year period, a 2% fee doesn't just cost you 2%. It can cost you almost half of your potential wealth. And that's because fees compound too, just in the wrong direction. Now, I know what some of you might be thinking, but I don't even know how to invest. I don't even know what a stock is. Well, it's simpler than you think. If you've ever opened a bank account, you can invest yourself. And the best part? If you're not comfortable learning how to actively trade, the S&P 500 is something you can buy just as easily as depositing money in a bank account. And here's the key. There aren't any fees, so you get to keep all the money yourself. Now granted, if you're about to retire in the next few years, this might not be the best option for you, but don't worry, there's still plenty of alternatives. In my very next video, I'm not only going to walk you through step by step how to invest in the S&P 500, even if you have absolutely no experience, but also what to do if you're nearing retirement age. What I really want to drive home is this, that even for those of you who know absolutely nothing about stocks, investing, or the market, you can control your future and likely save yourself hundreds of thousands or even millions of dollars in fees, allowing you to retire early. Now, I know a lot of times when we think of financial professionals, we may think of other professionals like doctors or lawyers, etc. But the fact is that the only requirement to become someone's financial advisor is a high school diploma. Now, I'm not saying that to hate on anyone, not at all. Some of the smartest people I know didn't go to college. What I am saying is that even if you never went to college, you don't have to be brilliant or study like a doctor or a lawyer who both took 4 years of undergrad and then went on to specialize for another 4 years in graduate school. The only requirement to sell securities like stocks is taking the Series 7 exam, which only takes about 2 weeks to study for. And sell is the key word there. What they get paid to do is sell you pre-packaged funds that their firms created. In essence, it would be more accurate to call them financial salespeople rather than financial advisors. Now, I don't mean to say that all financial professionals are bad people. Many of them have certifications and have studied finance in college. A big part of their job is helping people stay motivated to keep saving or acting as a bit of a coach or therapist because money can be a subject that makes people inherently nervous. But what you'll find as you begin to watch more of these videos is that it doesn't have to make you nervous. We're not talking about brain surgery here. And in fact, pretty soon, you may find that this is fun and exciting. And the other thing you'll definitely find is more money in your pocket. If you're watching this channel, we're going to get you ready to go toe-to-toe with any local financial advisor. Because again, No matter how educated or trained they are, remember that after fees, 80 to 90% of them don't outperform the market. I'm sure some of you are thinking, if investing in something as simple as the S&P 500 is so effective, why is there still so much money tied up in actively managed funds? Why do people keep trying to pick stocks when the odds are clearly against them? To answer that, let me share a fascinating experiment involving both mice and humans. In this experiment, a green and red light would flash at completely random intervals. The mice were trained to predict which light would flash next, and when the green light flashed, which was about 80% of the time, they got a piece of cheese. But when the red light flashed 20% of the time, they would receive a small shock. Interestingly enough, the mice quickly learned to always guess green and accept their fate the other 20% of the time. They didn't try and outsmart the system, they just went with the most frequent outcome. As a result, they were correct 80% of the time. Now, humans, on the other hand, couldn't help but look for patterns. They thought they could predict when the red light would flash, so they didn't always pick green. They tried to outsmart the randomness by guessing. The result? They were correct only about 68% of the time. Now, you may think this example with mice is a bit far-fetched, but consider that this isn't far off from what we've seen before in headlines of monkeys throwing darts at random stocks and yet still beating some of the brightest minds in finance. So, what's the takeaway here? We humans are natural pattern seekers. We have a hardwired desire to make sense of the randomness, to find order in chaos. This trait is incredibly useful in many aspects of our life. It's driven innovation, art, and science, but when it comes to investing, it can be our downfall. We believe people can spot trends, predict market swings, and identify the next big stock. This overconfidence leads many of us to choose actively managed funds or try our hand at day trading, despite some serious odds that these strategies will underperform in the long run. Now, I know some of my traders out there might be starting to think, but didn't you mention that you have a personal trading strategy that takes advantage of market randomness using the same mathematical models that were developed by some of the traders in the pits in Chicago and on the floor of the New York Stock Exchange? I thought you might be thinking that, and yes, I did. Let me explain. Over the years, I learned from several veteran traders who traded on the pits of the CBOE in Chicago and developed quantitative trading strategies, often referred to as quant strategies. These quantitative strategies often rely on mathematical models and statistical analysis. I focus on using these quantitative models to make trading decisions based on real probabilities derived from publicly available data on reputable brokerage platforms. Instead of relying on hunches or market rumors or drawing squiggly lines on charts, I analyze statistical data and historical data to calculate the likelihood of various market movements. This data-driven approach helps me identify opportunities where the odds are truly in my favor. These are also the same formulas that casinos use to make sure that the house always wins. Did you know that casinos make billions of dollars every year not by winning every game, but by having a slight advantage over players? Even a 1% advantage when played out over thousands of games guarantees profitability. I apply similar principles to my trading. Small edges can lead to significant gains over time. And this isn't just a theoretical concept. It's the same methodology employed by veteran traders and market makers. By leveraging these quantitative strategies, I'm able to make informed trades that are grounded in solid statistical reasoning. In essence, I'm using the same tools and data that professional traders use to navigate the markets effectively. So, is this approach right for everyone? Not necessarily, but not because you have to be a calculus whiz or some kind of math genius, though full disclosure, I am a total math nerd. It's because these strategies require time to learn, and you have to be passionate about it. See, I can teach anyone who's passionate. Again, I've worked with teens and college students to family offices making hundreds of millions of dollars. While this does require some learning, it's passion, not intelligence, that it takes to be successful. If you can count to 10, you can learn these strategies, but only if you're willing to dedicate the time. In my next video, I'll be beginning to share the how-tos of my personal strategy, and you'll be able to find those in the trading section of my YouTube page, which is underneath the finance section, which will be dedicated to more general advice like this. For those who are newer to finance and just want a reliable place to get started and take control of their own finances. So, What's the bottom line? For the vast majority of people, the most effective, low-stress way to build wealth is to invest in a broad, diversified index fund with minimal fees. This approach leverages the power of the entire market, reduces risk through diversification, and lets you benefit from the magic of compounding over time. We often overcomplicate things, thinking that the more complex a strategy is, the more effective it must be. But complexity for its own sake can be a trap. Simplicity, clarity, and discipline are your allies. Remember, start early, but it's never too late to begin. The best time to plant a tree was 20 years ago. The second best time is now. Stay the course. Markets will rise and fall, but historically, they tend to trend upward over the long term. Keep learning. Financial literacy is a lifelong journey. The more you know, the better decisions you'll make. And invest in yourself. Your skills, knowledge, and well-being are the most valuable assets you have. Let me leave you with a powerful story. In ancient times, a king wanted to reward a wise man and asked him what he wanted. The wise man pointed to a chessboard and said, "Place 1 grain of rice on the first square, 2 on the second, 4 on the third, and so on, doubling each time." The king thought it was a modest request and swore an oath on his crown to give it to him, until he realized that by the 64th square, he owed the man more rice than existed in the entire kingdom, and the man became the new king. That is the exponential power of compounding. At the end of the day, wealth isn't just about numbers on a balance sheet, it's about freedom. Freedom to spend your time as you wish, and to support the people and causes that you care about, and live life on your own terms. Imagine being able to retire earlier than you ever thought possible, traveling the world, spending quality time with loved ones, pursuing your passions, all because you made smart, informed decisions today. Don't let hidden fees and complex jargon steal your kingdom. Take control now. Thank you for joining me in this deep dive into investing wisdom. If this video opened your eyes, please give it a thumbs up and consider subscribing. Share it with someone who might be unknowingly giving away their hard-earned money and fees, because together we can empower more people to achieve financial freedom. Stay tuned for future videos where we'll explore how to invest in the S&P 500 step by step, even if you're starting from scratch, how to break up with your financial advisor, and of course, we'll begin to get into my personal advanced trading strategies that can take your investing to the next level. And I'll be sharing more about my personal story and how when I was a kid, I turned a $900 account into $1.4 million. And in the meantime, in the description below this video, I'll also share a link to the story and an interview I gave in a magazine. Remember, the journey to financial freedom isn't a sprint, it's a marathon. But every marathon starts with a single step. Make that step today. Until next time, stay informed, stay invested, and stay confident. The simplest path is often the most effective one.